Exciting stuff nonetheless, right, Brian? It's what we live for. Mitchell Stapley is Chief Fixed Income Officer at Fifth Third Asset Management. He certainly lives for this stuff. He's joining us live from Grand Rapids, Michigan. Great to see you. So a decent showing for the 5-year. What was behind it?
I think he had a 65 basis point concession that the market exacted from the 5-year since the beginning of the month. So, you know, if I look, I could have bought that security at, say, a 2% yield on November 30th versus a 265. I think that brought some people in, and the Treasury's got to breathe a sigh of relief from this. They knew they were trying to get a healthy sized chunk of bonds placed. They were able to do it at at a decent price. And I think this is one of those things that probably sets a 7-year up tomorrow in pretty good stead as well.
So if we're talking about 65 basis point concession, almost 2/3 of a full percentage point, are we going to need more concessions to take down even more debt that's coming down in 2010?
Yeah, I don't think there's any question at all about that. We're bearish on Treasuries and FTAM, and we think that trade's just going to continue on in 2010. You can pick your estimate, but we're running somewhere between $3 and $4 trillion in net supply between 2009 and 2010. And if I have any kind of recovery that continues in the corporate bond market, high yield continues to find a home for their debt, all that issuance out there is going to have a crowding out effect on Treasury yields in our estimation. And you're probably going to see yields work higher in 2010. We don't think there's a lot of ways around that.
What do you think, Mitch, of this pretty rapid pace of rising interest rates? What's the bigger picture?
Well, I think the bigger picture is this is something we need to get used to. We're coming off of an all-time low in terms of yields. 1 year ago today, we're basically looking at 5-year yields 100 basis points lower than this. We've seen a once in a decade, once probably in a fixed income manager's lifetime, hopefully, experience with rates down at these low levels due to the financial crisis. Now, as we get back to some level of normalcy in the markets, we've got to expect the rates begin to normalize, the curve begins to normalize somewhat. That's all going to spell basically higher rates in 2010.
So it seems like from an aggregate manager's perspective, you're saying you're bearish on treasuries. That means you want to own corporate bonds, other spread products. But so the search for yield is back, so to say. Does that mean that we're walking into the same aggressive performance of 2007, where managers were piling into a high yield and corporate debt, and that, as a consequence, was a bad thing?
I hope not. I think as you look at it, the rally's been more rational. You look at what happened in high yield. I think there's some froth there, and that's an area where we say you probably want to take some profits. In 2010 could be problematic for high yield. But investment grades, we've gone from that 5 standard deviation event wide last year, and then in 2008, and then the rally in 2009 has brought us back basically to the levels that we saw back in 2001 when we had the WorldCom Enron crisis, things like that. So we've come a long way back, but if I look at it historically, I'm not back to those tights of 2007 yet. If this rally continues by the end of 2010, then yeah, we're going to be looking at the fundamentals and making sure we don't go back down the path we went through with the blow up in 2007 and 2008.
The Fed, Mitch, as you know, has been talking about and proposing plans to start now to absorb the excess liquidity injected into the marketplace, into the economy, of course, at the height of the economy. What do you think in terms of this rapid pace of rising rates? Does it have anything to do with perhaps the Fed being perceived as being behind the ball, if you will?
Well, I think this might be one of those cases where, the Fed eased for the market in 2008, and the market's going to tighten for the Fed in 2010. One of the things you really have to look at, do I want to be owning agency mortgage-backed securities out here when I know on March 31 the going-away buyer that we've had in the market, the Fed, is going to be on the sidelines. Same thing with agency debt. So I think a certain amount of the reaction you're seeing in the marketplace in terms of higher rates is coming from the anticipation of the Fed basically pulling back these programs, these liquidity injection programs, which we're going to have to go through. And that's the biggest risk we've got out there, the risk of a policy mistake. I pull a program back too quick, causes rates to go up. I mean, what happens if we get a 6.5%, 7% mortgage rate? That's got huge consequences for the housing markets. There are a lot of risks out there.
Is that why you are bearish on treasuries? Because you think that the Fed is behind the curve, so to speak? Is that why you don't want to own treasuries in this environment, and they're making it too easy, too much credit, too available for corporate bonds to outperform?
Yeah, I think that's the issue. It's certainly from our estimation, as you look at the end of 2009 here, we thought it was basically as close as you could get to a quote-unquote rigged market. There was just so much liquidity in the marketplace. so much money looking to find a home that spread product was a place you had to be. Okay, there was really no question about it. And you see it happening in commodities and emerging markets, in the high yield market, investment grade bonds. Any spread sector got that huge wave that you had to ride on. Now as I go into 2010 and I begin to pull some of that out, the market's going to have to normalize at higher rates.
Mitch, last question. I'm sorry to cut you off. Anything out there that you see could be bullish for bonds? How does the economic picture shaping up?
Well, I think it's a slow growth environment out there, 2.5%, 3%. I don't think inflation's going to be an issue. So if I'm getting that 4.5%, 5% yield on a corporate, if I'm buying some high-quality CMBS, short ABS, I'm going to get that spread. And if I can have a book yield in my portfolio, 4.5%, 5%, that's going to look real attractive relative to what equities could do next year. So it's going to be not as exciting as this year, but still positive returns.
Mitchell Stapley of Fifth Third Asset Management and our Brian Luke, thank you both very much. Now